Welcome back to Talk Tickers. Today, we are turning our attention to the Midwest for a look at a bank that just reported earnings this morning, January 27, 2026.
Yep.
We are unpacking the fourth quarter results for First Merchants Corporation, ticker FRME.
It's good to be here. And, in a market that seems totally addicted to tech volatility and AI hype,
Right.
First Merchants gave us something that feels almost retro. It was remarkably boring, and I mean that as a compliment.
Boring is beautiful if it pays the rent, I guess.
Yeah.
But let's set the stage first. The call happened pre-market. We've seen the opening bell. How did the street react to this boring news?
The reaction was positive, but muted. I mean, the stock ticked up maybe 30 cents at the open.
So less than 1%.
Yeah, about 0.79%. So no fireworks, but crucially no panic selling either. This is a story of confirmation. The market expected a solid, steady quarter, and that's exactly what they got.
Steady is a loaded word in banking right now, though. It implies safety. But in a bull market, investors usually want growth. Is steady actually going to attract capital, or is this just a stock for people who want to hide?
That is the right question to ask. Right now, regional banks are being judged on like a holy trinity of metrics.
Okay.
Deposit competition, credit normalization. Basically, are your loans going bad? And the rate path. Are you sensitive to the Fed cutting rates?
Right.
FRME is trying to thread a very specific needle here. They're pushing for organic growth while simultaneously closing a major acquisition literally this week.
We are definitely going to dig into that acquisition. The mechanics there are fascinating. But let's just clear the deck with the headline numbers first.
Yeah.
They put some green on the board. GAAP EPS came in at 99 cents.
It's a beat, yeah.
A solid beat, or just squeaking by.
I mean, not a massive blowout, but a solid beat.
Right.
Consensus estimates were sitting at 96 cents, so they cleared the bar by 3 pennies.
And on the top line, revenue.
Revenue came in at $178.36 million, which beat by about $5.4 million. That's up 3% year over year.
Okay, so up 3% isn't exactly hypergrowth, but if you zoom out, the full year picture looks a bit different, doesn't it?
It does. For the full year of 2025, they posted record net income of $224.1 million. And their diluted EPS for the year was $3.88.
Which is up. What?
Up nearly 14% from the previous year. For a regional bank navigating this shifting rate environment, double-digit EPS growth is actually quite difficult to pull off.
And they aren't just hoarding that cash. I noticed they were fairly active with the buyback button.
They were. They repurchased $10.4 million in shares just in Q4. For the full year, it was nearly $47 million.
I always wonder about buybacks when a company is about to close an acquisition. Shouldn't they be saving that dry powder?
It signals confidence.
Yeah.
And it plays into the metric that really matters for bank investors, tangible book value.
Tangible book value. Let's define that quickly for folks who aren't bank analysts.
Sure. Think of tangible book value, or TBV, as the liquidation value of the bank. If you strip out all the intangible fluff like goodwill, it's the hard assets.
Right.
For FRME, that number is up to $30.18 per share. That's a 12.7% increase year over year. So when they buy back stock near that value, it's instantly accretive. It's management saying, we think our stock is on sale.
Okay, so the foundation is solid, but we need to pivot to the elephant in the room. You teased this acquisition, the First Savings Financial Group, or FSFG deal. This is closing, what, effectively now?
Literally this weekend,
Yeah.
February 1st. And this is really the pivot point for their narrative. But I want to be clear, this isn't just bank buys smaller bank to get bigger.
Which is the usual playbook, right? You buy assets, you cut HR, you call it synergy.
Exactly. This is different. This is a balance sheet restructuring play disguised as an acquisition.
Okay, explain that. What are they actually doing that's so clever?
So First Savings, like a lot of banks, was sitting on a bond portfolio that was, let's call it vintage,
Meaning low yields.
painfully low. They had about $250 million in securities, yielding next to nothing compared to where rates are today. They were essentially trapped holding them.
But First Merchants is buying them, so aren't they just inheriting that trap?
Normally, yes. But because of purchase accounting, they can mark those bonds to market immediately. And their plan is to liquidate the entire portfolio.
Sell it all on day one.
Day one, they are dumping $250 million of low-yield paper. Gone.
Why? Why not just hold them to maturity?
Because of the opportunity cost. Think about it. You turn that $250 million of bonds yielding, say, 2% into cash. Then you turn around and lend that cash out to a commercial client at 6.5%.
Ah, I see. It's an immediate arbitrage. You're swapping a 2% asset for a 6.5% asset instantly.
Precisely. And they're also using it to pay down their own expensive borrowings. It's like finding a suitcase of cash in the attic of a house you just bought and immediately using it to pay off your credit card debt.
That's a great analogy, but usually when you do something this aggressive, you need a cushion. You need to raise capital. Are shareholders getting diluted?
That's the kicker. Zero capital raise.
Really? They can swallow a deal this size without tapping the market.
Explicitly stated, they can digest this with existing capital. Their CET1 ratio is sitting at 11.70%.
Okay, another definition. CET1.
Common Equity Tier 1. It's the core measure of a bank's financial strength, their emergency cushion. Anything over 10% is considered well-capitalized. 11.7% means they have a tank full of gas.
That is a huge relief for shareholders. Okay, let's shift gears to operational performance. I want to talk about margins because this was a surprise. In a world where everyone's worried about margins getting squeezed, FRME's net interest margin actually went up.
It did. It increased 5 basis points to 3.29%. In this environment, that is notable.
But we have to be fair here. There was a little bit of a one-time helper in there, wasn't there?
There was, and credit to the CFO for being transparent. They had a $3.3 million interest recovery from a non-accrual loan.
Translate that for me.
A borrower who hadn't been paying suddenly paid up, including all the back interest. So it's a lump sum that hits the books.
Yeah.
If you strip that out, the core margin would have been slightly flatter.
Okay, so the headline number had an assist,
Yeah.
but there was another signal in the margin data that I think is actually more bullish. And it has to do with what they pay us, the depositors.
You're talking about deposit costs. This is the critical piece. The rate paid on deposits actually declined 12 basis points to 2.32%.
And yet they aggressively cut their deposit rates and the money stayed.
Exactly. It shows incredible sticky power.
Yeah.
But there is an even bigger tailwind coming. We call it the CD cliff.
A cliff usually sounds bad.
In this case, it's a beautiful cliff to fall off of. They have an $800 million block of CDs maturing in Q1 and Q2 of 26. These are currently costing them about 3.75%.
And what can they replace them at?
Current rates for new CDs are around 3.30%.
So it's like refinancing your mortgage at a lower rate.
Perfectly put. It's an automatic expense save. That savings drops straight to the bottom line. It's the opposite of what we saw 2 years ago. The cycle is turned.
Okay, let's look at the other side of the balance sheet. Let's talk credit and loan growth. The growth engine seems to be humming along.
It is. Total loans grew $197 million in the quarter. That's a 5.8% annualized growth rate. Full year, they hit 7.3%.
And this is mostly commercial and industrial, right? C&I.
C&I driven, yeah. They are finding places to lend money.
No, we have to address the scary number. If you just glanced at the release, you saw NPAs, non-performing assets, tick up. That's usually the fire alarm.
Right, and this is where you really have to listen to the call. There was a bit of a head fake. NPAs looked higher because of one specific credit, a $12.9 million multifamily project.
An apartment complex loan went bad.
It was marked as non-accrual, but, and this is the crucial context, that borrower paid off the loan in full after the quarter ended.
So the money's in the bank now.
Completely. The check cleared. If you adjust for that, their NPA ratio drops to a very healthy 0.45%. Incredibly clean.
However, it wasn't a perfect scorecard. There was a charge-off that stuck out. A $4.4 million hit related to sponsor finance.
Yes, let's unpack that.
First off, what is sponsor finance? Is it just lending to private equity?
That's exactly what it is.
Yeah.
Lending to companies owned by PE firms, they're usually highly leveraged.
So is this charge-off a sign that their whole PE book is leaking?
Management says no. They track about 90 companies in that portfolio. They call this an isolated hit, not a systemic issue. But, you know, it is a reminder that this kind of lending comes with higher risk.
And the other question investors always ask, office commercial real estate, the downtown towers, how exposed are they?
It's a non-issue. I can't stress this enough. Only 1.9% of their total loans are office. They simply do not have the downtown high-rise exposure that keeps coastal bank investors awake at night.
That's a key differentiation. So let's look forward. 2026 outlook, what's management telling us to expect?
The guidance is constructive. They're targeting loan growth of 6 to 8% for the full year.
And fee income.
They are bullish there, targeting plus 10% growth, double digits.
That seems ambitious.
Wealth management, card fees, but there is a counterweight. Expenses are rising.
Is that inflation? Or are they just spending more?
It's talent acquisition. Core expenses are rising 3 to 5%. They hired 15 people recently. They're in growth mode.
But wait, if expenses are going up, won't that hurt profitability?
In the short term, maybe. But remember the FSFG deal. They're targeting 27.5% cost savings from that acquisition. Those savings kick in during the back half of the year. So by Q3, Q4, They expect the efficiency ratio to dip below 55%.
Before we get to the final segment, I want to touch on the competitive landscape. There was a really interesting nugget in the Q&A about Michigan.
Yeah, President Mike Stewart dropped a little breadcrumb. He hinted at disruption among competitors, specifically referencing Comerica and Fifth Third.
Why call them out specifically?
Well, think about it. They're massive. When big banks get distracted by internal issues, their customer service often suffers.
And their best bankers get frustrated.
Exactly. Stewart is basically saying, while they are distracted fixing their own houses, we are stealing their lunch. It's a classic regional bank tactic.
I love that. Okay, we've covered the numbers, the credit, the deal. Now let's get into the weeds.
The fun part.
It is time for the This Is Not Financial Advice segment. As always, we are just two voices on a podcast, do not trade based on this. But
Right.
if you were a hedge fund analyst, what's the trade?
I call this trade the Rust Belt arbitrage.
Rust Belt arbitrage. Sounds gritty. I like it. What's the play?
The play is long first merchants, FRME, and short coastal office exposure.
Okay, break that down. Why this specific pair?
All right, so the rationale. FRME is dominating southern Indiana and Louisville. They have zero office exposure, but the magic is in the deposit beta. Their costs are falling faster than their yield is dropping.
It keep more margin.
Correct, so the long side is a play on that CD cliff. You're betting the boring industrial Midwest outperforms the flashy coastal markets.
And the short side?
You short the coastal banks that are still neck deep in office space and are still fighting a deposit war. You're betting against the banks that have to pay 4 or 5% just to keep customers.
So it's a geography play and a balance sheet play wrapped into one.
It is. And here's the kicker, the free option.
The suitcase of cash.
The suitcase of cash. They are liquidating that $250 million bond portfolio. That cash hits the balance sheet on February 2nd and gets redeployed from earning 2% to earning 6.5%. That is pure arbitrage sitting right there in plain sight.
It's like finding a $20 bill in your winter coat pocket, but the coat is worth $250 million.
Precisely. The market has priced this as a steady quarter. I don't think they fully priced in the mechanics of that bond shuffle.
A compelling pitch. Again, not financial advice, just identifying where the alpha might be hiding.
That's what we do.
All right, let's bring it home. Wrap this up. What are the key takeaways?
4 things. 1, they beat. Steady execution. 2, the first savings deal closes February 1st. Watch for that cash. 3, credit is cleaner than it looks. And 4, the guidance is constructive.
And if you take one thing away about the future of the stock,
The market shrugged at this. It was expected. But the real story isn't Q4. The real story is the operating leverage coming in the back half of 2026. Watch the efficiency ratio. If it dips below 55% while they are growing loans at 8%, this stock re-rates higher.
boring is beautiful and steady wins the race. We will leave it there. Keep watching the tickers and we'll see you for the next print.
Thanks for listening.